Right, so let's now move on with the second part of the question, where we now have to analyze and interpret the financial indicators that we've calculated. So the next question, I want you guys to please pay attention and focus, because this one is a common question in your exams. Explain why the directors decided to reduce the long-term loan. Okay, so reduce, they obviously made a payment, they reduced their long-term loan significantly during the current financial year. So obviously they paid off a certain portion of their loan in 2009. In your opinion, was this a wise decision? Okay, was it the correct decision in terms of the business itself? And they want us to explain, quoting evidence from the question itself. Okay, so guys, be careful with these type of questions, because you can clearly see there are three parts to the question. So what I've done is I've actually broken this down. So if we go to our answer sheet, right? So they want us to answer, why did the directors reduce the loan? So that's the first part of the question. Was this a wise decision? Right? A second part of the question, yes or no? And they want us to explain, quoting financial indicators. Right, so remember, if you pay off your loan, how does this now benefit the business? Was this a correct decision for the business? So what I want to do is I want to start by looking at the balance sheet. So if we look at the balance sheet, guys, just pay attention now, please. So the balance sheet, if we look at 2008, as we can clearly see, in 2008, our loan was sitting at 1,525,000. Okay, right. Then if we look at 2009, so the loan has dropped. It has significantly gone down, and as we can see, a payment towards the loan was made, and quite a large payment was made. If we take out our calculators, let's just quickly see how much was actually paid. So if we take the loan amount, 1,525,000 minus 300,000, okay, so the business paid back quite a large amount, 1,225,000. Now the question is asking you, why do you think the directors made this payment? Now there are various answers you can give, and I'm going to try and answer as many as I can. Okay, so let's start off with firstly in 2008. Now, if you look at 2008, you don't have to do the actual calculation, but if you look at, I'm going to write at the top, guys, if you look at the debt equity ratio in 2008, we can clearly see that our equity, okay, 1 million, so our equity was 1,443,000. Right? And if we now compare that to our debt was obviously much higher. So if you look at this ratio, and I'm going to quickly do a calculation. So if we take our debt, 1,525,000, and we divide that by our equity, 1,443,000, okay, as we can see, our ratio, the business was actually high geared. So we ended up with a ratio of 1,05, or if I round that up, 1,1 is to 1. Right, now what did that mean in 2008? The business was high geared, they were high risk. Now remember, when you are high risk, it basically means you rely more on borrowed capital than own capital. Right, so obviously that situation is not the situation that the business wants to be in. So by the business paying off their loan, they were then able to become low geared. So how do we know they were able to become low geared? So if we go to the question, the previous question that we calculated, okay, you can clearly see that the business in 2009 is now low risk. Okay, so from being high risk, the business has now become low risk. So that could be one of the reasons. Okay, so one of the reasons could be gearing, right? In 2008, the business or the company, whatever you prefer to say, the business was high geared. Okay, or you can say the business was high risk. And by paying off the loan, the business is now low risk. So in 2009, the business is obviously now low risk. Okay, so that could be one of the reasons why they paid off the loan. A second reason, and this reason, guys, is very, very important. So again, listen very carefully. If we go to our financial indicators, and I'm going to try and use a different color now. So if we again look at 2008, our return on total capital employed, so our return on total capital employed was sitting at 10%. Okay, that was the return, what the business was getting out, the profits that the business was able to generate from using the bank's money. So if you look at the interest that the business had to pay, right? So if I go to my balance sheet, my non-current liability, the interest that the bank is charging me is 15%. Okay, so let's go back to return on total capital employed is 10%, and the interest that the bank is charging me is 15%. So clearly I can see it wasn't worth me borrowing this money because I'm making 10%, but I'm paying the bank back 15%. Right, this is what we call negatively geared, right? When your return is lower than your interest. But if we look at what happened in 2000 and, okay, I just want to try and bring that up. Right, so if we look at, there we can see it, so it shouldn't be an issue. If we look at your return in 2009, it was 24%, guys. So again, if you look at your return on total capital employed in 2009, the return is now 24%. So obviously, by paying off that loan, the business is now positively geared. Their return is higher than the interest that they are paying. So that could be the second reason that you could use. So you could talk about return on total capital employed. In 2008, okay, the return was lower, okay, than the interest rate. And remember, they want you to substantiate. So the return was 10% and the interest rate was 15%. And we can clearly see now that it's a different scenario, a different situation. Right, was this a wise decision? The answer is yes. Obviously, it was a wise decision because our return on total capital employed is now higher, okay? It's now increased, or it's higher than your interest rate. Okay, and if we go back to our return, right, it was on that previous page, the return was sitting at 24%. Okay, so my return was sitting at 24% compared to the interest, which was sitting at 15%. Okay. Right, so guys, I want to take a quick break, and while you guys are doing that, I can obviously just quickly fix a bit on that last question.